Okay, I think we can start now. So hello, everyone. Thank you for being here today. My name is Hélène Prokudin-Gorski. I'm CDP's Capital Market and Policy Officer, which essentially means I'm the person connecting with investors on anything related to EU sustainable finance regulations. I also represent CDP in the EU platform on sustainable finance. For those who are familiar with this working group, where a lot of our work focuses on the usability of data in the EU framework. So it's connected to a lot of the things that we're going to talk about today. And maybe a bit more about myself. Prior to CDP, I was working on the investor side of things. So I was doing investment research, focusing a lot on the sustainable transition, and more in the recent years, the integration of EU regulations. So I got familiar with some of the challenges associated with implementing those. This webinar is the first of a series on EU sustainable finance. And here we're going to focus on a concept that is now widely used in the industry, but that has been sort of introduced in 2019 by SFDR. And those are principal adverse impacts, or PAIs or PASIs. The webinar is meant to satisfy a wide range of audience and degree of expertise on those topics. So hopefully it will be useful for everyone, but if you feel there are specific aspects that were not covered and that you'd like to discuss in more details, I really encourage you to reach out even separately. So just some housekeeping rules. I'm going to try to keep some time at the end of the presentation for Q&A. So please just write your questions in the chat. And if I cannot answer them, I'll reach out separately and try to answer them offline. The event is being recorded, and so the slide and the recording will be shared afterwards. In terms of agenda today, the agenda is quite simple. We'll start with an overview of sustainability adverse impacts, what it means, where they appear in different parts of the regulatory landscape, and what are the indicators that have been introduced by EU regulators to quantify those adverse sustainability impacts. Then we'll go over some application. So the purpose is to highlight that those are important indicators that can be used beyond reporting. And finally, we'll touch on data, how you can leverage CDP to understand your exposure to adverse impacts and potential solutions to deal with the lack of data for certain indicators. So starting with the overview, I thought it would be useful just to take a step back from numbers, data, indicators, and before we talk about those, to remind ourselves of what is an adverse impact, because it feels that there could be a wide range of definitions. And indeed, it turns out that there's not one single definition of what is an adverse impact. Some things that appear really regularly in regulations in general, even that have nothing to do with sustainability, is that an adverse impact is an impact that independently or cumulatively damages, diminishes, degrades, impairs, destroys, or otherwise harms. In 2019, SFDR also introduced a definition that is related to the financial sector, and about principal adverse impacts that should be understood as the impacts of investment decisions and advice that results in negative effects on sustainability factor. So it can seem to be still relatively vague, but something that we do know is that the scope of adverse impacts go beyond climate. They touch on the environment in general, and they also there is also a focus on social and human matters. And finally, a definition introduced by the CSRD in 2022, which is the Corporate Sustainability Reporting Directive, that gives us an indication of the differences between potential adverse impacts and principal adverse impact. Is that a principal adverse impact is ranked among the greatest impacts based on gravity, scope, scale, and whether the impact is reversible or not. So why does it matter? What this tells us is that there's a clear role of materiality in assessing adverse impact, and there's also a clear room for subjectivity as well in defining those terms. So EU regulation have attempted to find a way to harmonize the measurement of adverse impact, but it's important to reiterate that at the end of the story, the extent to which an impact causes harm is highly dependent on context. And one example is that water withdrawal will not have the same impact depending on whether it's fresh water or seawater, and it won't have the same impact depending on where it's happening. So it's highly dependent on the geospatial properties of the activity. In the concept of SFDR, for those who are familiar, you have the principal adverse impact and additional/optional ones. And it's important because the list of principal adverse impacts is really meant to represent the impacts that are always negative regardless of the context. So if you think about pollution of water, destruction or impairment of biodiversity, fossil fuels, and the additional ones probably depend a bit more on the context. And since they've been introduced in the Sustainable Finance Regulatory Framework by SFDR in 2019, they've been referenced across the board of regulations related to sustainable finance. And I'm probably even missing some here on this slide, but just starting a bit with SFDR and the technical standards, it really introduced some indicators to quantify adverse impact, spanning around themes that are environmental but social as well. And just focusing on the environmental indicators, there's been 30 environmental indicators introduced, quantifying 25 adverse impacts. And amongst that, there are 9 impacts that are deemed as principal. And because those indicators were meant to apply to the financial sector, they also were made to relate to different asset classes. So companies, real estate, sovereigns, and supranational. Now, principal adverse impacts also have mention in other parts of regulation. So they are actually referred to in the EU Taxonomy regulation that was adopted in 2010 in 2020. And PAIs are used in reference for the guidance that was given to design the taxonomy screening criteria. And very importantly, the taxonomy regulation establishes the 6 climate and environmental objectives of the EU. And it's important related to PAIs because principal adverse impact are often used to think about doing or not doing significant harm to those climate and environmental objectives. So they are very much related to one another. PAIs are also very much present in other parts of the regulatory framework, amendments to MiFID, UCITS, alternative funds regulations, for example, having due diligence regarding to principal adverse impact, integrating them into sustainability preferences and product governance. And finally, very importantly, they are a core part of the CSRD that has been adopted at the end of last year, which is the counterpart of SFDR for companies, the Corporate Sustainability Reporting Directive. And here, adverse impacts are very important. They're present in the materiality assessment. They're also a concept that needs to be understood beyond the boundaries of an organization. So there's a strong focus on the value chain. And very importantly, the whole list of indicators that are presented under SFDR are present into the standards of the corporate disclosure requirements. So theoretically, all companies that fall under the scope will need to report on the indicators that have been laid out in SFDR. So last part of this section is the indicators themselves. It's worth noting that during this presentation, we'll focus more on the indicators for companies. and related to environment and climate. This is because of the nature of the work we're doing at CDP. But you can see on this slide essentially a listing of all the indicators, principal adverse impact, additional adverse impact, and trying to organize them by climate and environmental objective. And it's not such an easy exercise because there's a lot of interdependencies between climate and nature, for example, but even within certain themes like biodiversity, there's very much of an interaction between climate change, water, forest, for example, in driving biodiversity loss. So what this exercise helps to do is essentially to realize that some indicators can be present and useful to think about different climate and environmental objectives. So for example, sustainable ocean and sea practices can be relevant to assess impact on sustainable water use, but also biodiversity. And another thing that I think was useful in this exercise of mapping, looking at the sustainability reporting standards of the EU that are at draft stage at this point, was that the principal adverse impact emissions to water, that is the only water-related principal adverse impact indicator, is actually listed under pollution prevention if we're looking at the different ESRS drafts that are tying those indicators to the specific objectives. So maybe now, all those indicators, how are they used in practice for sustainable finance? So in this section, the aim is not to give you recommendation on how to use the indicators, but rather give evidence-based illustration of market practices, what we've seen happening in the market, and what has been sort of explained / validated by answers from European authorities in various Q&As and FAQs. So starting with applications from a pure regulatory standpoint, we'll focus on disclosures under SFDR. So I'm sure people are familiar with this regulation in this call, but just to summarize, this regulation was introduced sustainability disclosure for the financial sector, both at the financial product level, defined such as UCITS funds, alternative investment funds, pension schemes, pension insurance products, and others. But they also introduced disclosure requirement at the entity level. So for financial market participants that are essentially conducting those portfolio management activities in the EU. And first at the product level, you have certain products that tend to do sustainability, to make sustainability claims. And now they're widely known as Article 8 and 9 products. But part of the template that those funds need to fill out and disclose on, there's this question of, do you consider principal adverse impacts, which has raised some issues because it's relatively vague. But essentially, those products also need to use PAIs for other elements of their disclosure, for example, to demonstrate good governance. And also a very important aspect is that any sustainable investments need to use principal adverse impacts to demonstrate they do no significant harm to the other climate and environmental objectives. And finally, there's also an element of disclosing sustainability risks for products, which we'll see a bit later, can also relate to principal adverse impacts. On the entity side of things, entities, so financial market participants, should disclose whether they consider principal adverse impact. And if they do, it goes with the yearly PAI statement. The first one is due in June 30th of this year. And it's a template that essentially lists all of the principal adverse impact in a quantitative way, which means that financial market participants have to report for all their investments under the scope on all those indicators, but they also need to compare it to the year before. They need to disclose any targets in place to address them, policies in place to identify and prioritize, and engagement policies. And similarly, entities should disclose how they integrate sustainability risk. So let's assume that a financial market participant or product fund manager has collected all of the adverse impact indicators, has a perfect visibility on that, transparency, perfect access to data. So what does it mean? What role does it play in investment decision is actually the most important part. So here it's just to think about some of the applications of principal adverse impact in investment strategies, and trying to think a bit beyond reporting and how they can play a role in investment decisions. So to the question, do you consider PAIs? Obviously, it can mean a lot of different things. The EU regulators have clearly stated that there's nothing that is prescriptive. It can be quantitative, for example, using systematic strategies, optimization. It can be qualitative, so more on the discretionary side of things. It can be part of exclusion strategies. But what matters is that it's binding. And that means that there's a control in place. That means that there's a pre-trade assessment for a PAI to be considered, which essentially means it just needs to play a role in the investment decision. And any quantification that you might specify will mean that you have to track this data through time. And interestingly, considering principal adverse impacts are not exactly the same thing as promoting environmental and social characteristics, which is essentially the definition of Article 8 product. So a good example of things that we've been seeing in the market is using some of the social PAIs like controversial weapon or exposure to companies that are breaking the rules of UNGC to then consider PAIs, but it doesn't necessarily mean that they are used for the promotion of environmental and social characteristics. But that being said, those indicators can be used for that purpose. So for example, the decrease of potential negative impact like carbon emissions, emissions to water, negative biodiversity impact, or the increase of positive impact, like the percentage of renewables, are things that that are seen to be employed to promote environmental and social characteristics. It's also present in the definition of sustainable investments. And if we think about a particular case of sustainable objective, which is GHG emission reduction strategies and targets, the main input in that is GHG emissions, which is at the end of the story a principal adverse impact. And it's also the main input in any risk and return assumptions related to climate risk and scenarios that use carbon emission as the main input. So what is starting to appear is that principal adverse impacts are everywhere, and that considering principal adverse impacts is one thing, but considering all of them can be more challenging. We often see a focus on GHG emissions data, on things like OECD guidelines or UNGC, controversial weapons for social, but we are not really there yet for nature-related indicators in particular. And it's very important because in the context of sustainable investment and in the context of do no significant harm, you're supposed to demonstrate that your sustainable investments are not doing significant harm to any of those other environmental objectives. So theoretically, there should be indicators that are representing all of the different environmental objectives, among which the more nature-oriented one, like biodiversity, water, for example. There's unfortunately not a lot of guidance on how to define that. There's certainly a lot of lack of common definition of what it means to do significant harm for a company, for example. And just taking back the example of indicators, we know that emissions, pollution of water somehow always causes harm, but how much a company needs to pollute water so that it causes those irreversible losses for nature or that the impact is scaled in the way that means we should not consider this company to be a sustainable investment? Is there any pollution to water threshold we should be using? And there's not a clear answer to that, but what has been given as a clear guidance, contrary to what we've seen emerging in industry practices, is that controversies shouldn't be used to assess to no significant harm because they tend to be too low in terms of threshold. That means you need to define your own thresholds. And actually, I'll take this opportunity to mention that there is currently a consultation for SFDR that is open, that you have until the beginning of July to answer if you wish. And in that consultation, European authorities are considering asking the disclosure of those thresholds for do no significant harm to enable the comparison between products. Now, in order to set the thresholds, you usually need the distribution of data. As we've mentioned, unfortunately, data is not always available for all indicators and for all of the investment universe you might have. And finally, there's a coherence issue that has been raised between the do no significant harm as defined by the EU Taxonomy, which is activity level versus the entity level in SFDR. And that can be a problem, for example, for specific asset classes like green bonds or use of proceeds loans, for example, that are essentially channeling money towards sustainable activities. But because we are measuring PAIs at the entity level, the issuer level, then they might not be counted as sustainable investments per se. A final application that I'd like to raise in terms of how adverse impacts can play a role in the broader financial ecosystem is that they matter actually for risk assessment. So double materiality is a concept that is present all over the EU Sustainable Finance Framework, incorporates reporting as well. And while those two things are different, impact materiality and financial materiality, it is not exactly the same. One example is that you can suffer from the effect of climate change without yourself contributing to it, for example. It's still very much related. And it's related essentially through the notion of transition risk. So, with the regulatory landscape evolving, with consumer preferences changing, most likely a company that has high impacts on climate and nature suffers the risk of the financial risk of transition risk. And another important point is that when it comes to natural resources, as opposed to carbon emission or GHG emissions, there's a bit more of a clear overlap between pressure points and dependencies. So transition and physical risk. So for example, the paper and forestry sector might have a relatively large pressure point on nature, but they're also highly dependent on it, which can represent both a transition and a physical risk. So in a nutshell, your impact assessment will also help you assess part of your financial risk, and principal adverse impacts are a good start to show you the potential impact of your investment on climate and nature, which in turn represents a risk for your investment. Those are real life examples of what I've just mentioned. I think those are not just conceptual statements. There's been an increasing number of cases where you really saw the equity value losses of companies, that have been subject to suspensions and fines related to their nature impact, or, for example, the meat industry related to their water pollution. And this is my way to say that we should be very much focusing on nature as well and not overlook those adverse impacts just because we have issues with data. And the last point that I'll make is that climate and nature don't go one without the other. So even if you have a lot of policies, strategies, targets related to climate change mitigation and carbon emission, it's also intrinsically related to nature. So the example of land conversion and deforestation, its impact on nature, but it will very much also be important in the context of climate change mitigation. So maybe now we are moving on to the more practical section of this presentation, the data side, and what steps we can take to get all that information and how CDP can help. So just in a nutshell from the previous sections, are that adverse impacts are very important across the sustainable finance framework. There are a lot of indicators at stake. That means a lot of data, and they have many potential applications for sustainable finance. And I'm not going to spend too much time convincing you that one of the main issues, unfortunately, there's not a lot of data available out there for adverse impact indicators to become mainstream yet. That's less and less true for climate related indicators. I think there's a fair amount of progress that has been done, but that's very true for other environmental objectives like water, biodiversity, pollution, circular economy. It's widely acknowledged, and so the corporate reporting in the EU is transforming to incorporate mandatory disclosures on those indicators. But there's a clear timeline gap for this to happen. So the first principal adverse impact indicator that will be reported under CSRD for a certain number of companies will happen in 2025, covering the financial year of 2024. And also it will only be for a subset of companies. So another issue is, of course, coverage gap. Even in the best case scenario where all companies under the scope of CSRD disclose on those indicators, investors that might have international exposures, it's likely that you'll still not necessarily get that data for all of the companies in portfolios. So how do we get started without data? So on the concept of identifying and prioritizing a principal adverse impact, which is also part of the SFDR requirements we mentioned earlier, one way to go around it is to use materiality metrics. So what you see on the screen is a snapshot of CDP's forest and water matrix. And those are at the foundation of how we build our samples when we request companies to disclose on certain themes. And the idea is really to assess and rank activities depending on the impact that they have on those different themes. And then looking at the company level, the percentage of revenues that they generate from those activities. And what it really enables is to prioritize the focus on specific areas that might represent heightened risk of adverse impacts. And you can evaluate your portfolio's potential impact. And as I mentioned before, it can also be an indication of potential sustainable financial risk. There are other examples of those kind of metrics elsewhere. So, for example, there is similar exercises that have been done for nature regarding the dependencies of certain industries on nature, and that's an example from the World Economic Forum, one of their publications. But this is to say that there are tools available out there for you to run those materiality assessments and identify potential risks. Second is what you can get out of CDP data for actual measurement. So on the left-hand side, what I mean by planet scope is that we are continuing our work to expand and cover all planet boundaries. And that means that we've evolved from climate to also building a lot of expertise in-house for themes like water, forest, biodiversity. There's definitely things that we don't cover yet, but this is at least a solid holistic picture of the environmental themes that we've discussed earlier. We also started to collect data on plastic this year as well. And I think it's an important step also towards thinking about circularity. For those who are familiar with CDP, we are focusing on corporate disclosures, but we're also doing a lot of work with cities, regions, and from a corporate perspective, we work both with public and private companies and also SMEs. And finally, the right-hand side sort of bucket, what is quite interesting is that while adverse impacts are a very good starting point, they don't tell you much about what a company is doing to address them. So here, having a more comprehensive view of a company's environmental performance enables you to also think about forward-looking indicators. So in the same way that you have carbon emissions, but then you have targets and SBTIs. And this is more practically a snapshot of the exact mapping that we did, comparing CDP questionnaire and the principal adverse impacts that are listed under SFDR. So we also added two of the additional indicators in that table, so water consumption and water source from areas of stress. But those are the questions that correspond exactly to the official, in terms of indicators, to the official regulatory ones. But as I mentioned already, there are notably additional adverse impacts that can be harder to define. For example, sustainable land practices or activities contributing to land degradation. And here, again, CDP collects data that can be very useful to inform this, notably in our sector-specific questionnaire. So I think it's important to keep this in mind, and I encourage you to reach out if you're interested in discussing more on specific of those adverse impacts, because we might also have very informative indicators that can be used to also drive quality in estimations. We also, of course, collect information on carbon emission reductions, deforestation policy, water policy. So what you see on this slide is the information that is needed to calculate 8 out of the 9 principal adverse impacts, because then you, of course, have the use of various denominators like enterprise value, revenues, and filters like high impact sectors and so on. And I'll take this opportunity also to mention something regarding the lack of data available, obviously recognized by regulators, has introduced the notion of flexibility in using estimates when there's really no data available out there, which is somehow a good thing. It's not to say that estimates are not useful and are bad altogether, but it's also created a lot of dispersion across the industry in terms of how one company will be assessed by different market participants or investors, depending on the methodology that they use. And something that has been also going back to this consultation on SFDR, something that has been brought forward is to actually consider as best practice and to potentially make mandatory the disclosure of the percentage of your indicators that you have you directly got from companies' reported data compared to the share of those indicators that you got from estimates and proxies. And I think that it's important to mention those two steps that we just talked about, so prioritization and identification and measurement are the beginning. And I like bringing this SBTN framework here because I think at the end it illustrates that all we're doing is running a materiality assessment, prioritizing and then measuring. And it doesn't mean that it should stop there, that it should lead to disinvestment. But it is absolutely necessary to start with those steps, to think about then potential targets or to think about engaging with your investee companies. And that leads me to my final step, for now at least, which is engagement. It can be engagement to get data. It can be collective engagement that you can run through CDP, through different channels, or engagement that you run on your own, depending on the policies you have in place in your organization. And it can be engagement for impact once that you actually got the data, and if you'd like a company to change their practices, for example. So CDP provides a platform to collect the data, but it's incredibly important to remember that engagement is essential. So this year, for example, we launched a program, an engagement program called the Green Finance Accelerator, where we partnered with a series of investors to encourage companies to disclose on their principal adverse impacts, but also to make sure that it's actually a useful process for them. Because first of all, some of them need to prepare for their own mandatory disclosures, but also because at the end of the story, it's important for them to assess their own risks. So we've talked about it. It is actually related to business and financial risk. And the end goal in all this is that actually this data, those indicators can be used in a meaningful way by all stakeholders. So on the topic of going beyond reporting, basically. So finally, I wanted to make those 3 steps a bit more tangible using CDP data. So I'll just walk you through an illustration for water that I've put together based on CDP 2022 disclosures. So on the left-hand side, what you can see, and just stressing the fact that those are illustrations, but what you can see is that I had a look at the number of companies that were part of CDP sample last year for water risk, which is, as I explained earlier, when I showed you those materiality matrix, or CDP samples are a byproduct of the materiality assessment of activities and a company's revenues that they derive from those activities. And last year, we had a bit more than 3,000 companies in the water sample. Then what I did is that I select only the companies that amongst the sample were assessed as critical, very high, and high impact level, to keep only what I think were the highest impact levels. And I ended up with around 2,400 companies. So that was the first step of my materiality assessment. I didn't have a portfolio to map, but if I had a series of holdings, I could have, had a look at what it looks like for my holdings. Now, we, as CDP, we ask those companies to disclose, but not all of them choose to disclose to us. So out of those companies, 1,200 approximately disclosed data to CDP related to water. And I was interested particularly in looking at the water consumption metric. That is one of the adverse impact. Amongst the companies that disclose to CDP on water, there are some that answer to a series of questions, but that didn't answer to that particular question. And my final sample essentially for water consumption was that I had 1,000 of companies that disclose data on their water consumption indicator specifically, which means that I could have a look at the distribution, and that you can see in the middle graph, and also get some descriptive statistics. So for example, on average, within that sample, the companies that disclosed on their water consumption on average, consume approximately 128,000 megaliters per year, which is approximately 128 million cubic liters. My minimum value was negative, which I thought was odd. And then the maximum value that I got reported by a company was a clear outlier, reported over 3 billion megaliters, so more than the total water consumption of the US per year. So I believe it was potentially a mistake of unit, and I excluded it from my sample. And as you can look at the graph, the left-hand side in particular, you have actually 26 companies, to be precise, within my sample that represent 90% of the total water consumption that has been reported to CDP. There's been a few flags that I noticed. So 11 reported negative water consumption. We're talking about chemicals companies assessed as critical for water, so it's unlikely that they have negative consumption. So we can interpret that as a misinterpretation of the question or the units, and 50 reported 0, which is, again, reminder, we're talking about companies that have been assessed as having potentially critical, very high impact on water. And the good news is that last year it was, 3,000 companies on CDP water sample. This year, actually, CDP asked over 6,000 companies to disclose on water. And that includes the new indicator on emissions to water, which is one of the principal adverse impacts, which is very important because we need to engage with companies to try to get data in quantity and in quality, which leads me to my third point, which is how can we use this information to engage? So highlighting that those are just illustrations, but if you look at the first row of this table on the right, one strategy is just to take companies that were on the sample, for example, and decline to answer altogether. So that's approximately 1,000 companies. We have a campaign for this at CDP. It's called the non-disclosure campaign, but you could do some engagement on your own. And another type of engagement is that amongst those companies that reported on water, as I mentioned, some didn't disclose on their water consumption, and it could be for a various number of reasons. Some, for example, just do not monitor their water consumption. Some reported that monitoring water consumption was not relevant for their business. Some just simply did not disclose any data. So here again, that's kind of highlighting that the richness of CDP data can be daunting sometimes, but it's also very useful to get this extra layer of nuance that is important to drive engagement. And finally, and I'll stop with this. My last example on the bottom row of this table is that for those who'd like to go a step further, I used my 26 companies that represent 90% of total disclosed water consumption, and I checked the ones that reported not having any water policy or not planning to develop a water policy in the next 2 years, because it's also data that we collect at CDP. And here, for example, there were 3 companies. So those are just illustrations, hopefully bringing a bit of more of a concrete approach in how, even if there's a widely recognized lack of data for certain of those indicators, and it's definitely something that we are working to make progress on, you can still start making those kind of analysis and hopefully driving disclosure and driving impact for the companies you're investing in particular. So that's it for me. Thank you very much for listening, and I really encourage you to reach out also if you want to discuss some specific aspects, whether it's of the EU regulations or whether it's of CDP's data, how that can help you. There's an email there, but when we will share the slides and the recording, I will also add my own email. And perhaps now I'll see if there are any questions. And I think, unfortunately, somehow because I'm presenting, I cannot see the chat, but my colleague Rita is on the line. Yes, thank you.
I'll jump in to give you a hand. We only have one question, and I'm not sure. I know there's another one that popped up, but Sylvia asked where the first materiality map is from. Do you know what Sylvia is referring to?
Yes, I believe it's this one. This is actually an extract from documents that are publicly available about how CDP is constructing their samples. So if you look at the bottom part of the screen, for example, it's part of the way we construct our CDP water sample. So the number of companies that will be asked to disclose on water metrics. And there are specific methodologies, notes, and guidance that I can share with you afterwards as well, available online on how this is done, so in full transparency, and a table. This is not the full tables that are shown. There's actually quite a comprehensive list of sectors of activities, or activities, sorry, with their impact assessment for various teams. So yeah, that one comes from CDP. The one after that is more broad to nature is coming from an external source, the World Economic Forum, but it's an illustration that there are things out there even in academia and in other supports you could get.
Okay, thank you. And then Luca asked if you can provide more color on quarterly PAI calculation. I don't know if you can elaborate a bit on this.
Yes, I mean, what I do know about it is that, of course, because a lot of, well, actually, what I can tell you about it in the context of the scarcity of data, specifically for even carbon emissions, actually, it tends to be more slow-moving data that you collect at the best yearly, at the best, is that the quarterly PAI calculation, or rather focusing on how the exposures of your portfolio changed. So the idea, and that's things that I can also provide some material to you in terms of FAQs and Q&As provided by the different European authorities that have clarified elements of that question that you have to work with the latest indicator available for the company in terms of the principal adverse impact. But it's not expected of you that you'll have high frequency information on those indicators. So the quarterly element comes more from the fact that your portfolio expositions might have changed through this year. So if you completely had a huge turnover of your portfolio, for example, and change your allocation drastically, well, of course, having the same metric for the PAI for the year will still give you a different total number if your allocation changed through the year.
Okay, thank you. And then Michelle has a question on PAI statements. She says that the PAI statement is on entity level for the financial market participants. So she asks if you can expand on how to report, for instance, if there are two Article 9 products where one is larger than the other. And if you have several Article 6 products that do not consider PAIs. I don't know if that was super clear. I can read that again for you.
So my interpretation of the entity level disclosure is that it should include, any of the investments that are under the scope of the financial market participants. So whether you have 2 funds, 100 funds, or what, it should be an aggregation of absolutely all of the investments that are under those portfolio management activities defined in the regulation. So essentially, there's not going to be a real differentiation between whether you have Article 9 products or not. It's essentially at the entity level. If you have said that you're disclosed that your entity is considering principal adverse impacts in your statements, you will essentially need to aggregate all of the exposure that you might have across different funds, which is why it's so challenging and difficult.
Okay, and then we have one more from Francesco. He's asking about where is the platform for engagement about PAIs available? I believe this might be about the accelerator. Could this be?
Yes. So Actually, the deadline has passed. We have done quite a bit of engagement with investors throughout the months of January and February. So it's a program that we've just launched as a pilot this year. So this is where we've worked, let's say, under tight timelines, because now the disclosure platform for companies are open. So we wanted to recruit investors prior to that date. But to be very honest with you, we are obviously also seeing what's the appetite for investors, whether it's useful for them. And so if you reach out separately, I'm sure we can, no matter what, whether it's precisely within the scope of this engagement program or through the various channels, I'm sure we can. I mean, the ultimate idea is that we're useful for you to engage on those topics. So we can talk about it offline.
Okay, and one more just came in about asking where on the CDP platform can we find the CDP impact matrix?
Yeah, so this is on our website. So it's under one of the sections that are explaining how we select companies. To be very honest with you, I myself had issues to find it Googling, so I will send you the link. It will just facilitate everyone's life. It's one part of the website that essentially will give you the exact methodologies on how CDP is constructing their samples. So you will find that impact metrics.
Okay, and I don't know if this is the last one or not, but Michelle has a question about the PAI deadlines. She says that CDP usually as often published past the June 30th deadline for the PAI statement, and she asks if information will be published earlier this year for
This
investors.
is a very good question, very important question. Very unfortunately, no. So the way we work at CDP so far, and I'm stressing that, hopefully no one of my colleagues are present in the call, but no, I will say that this is something that I believe should evolve because of the new regulatory landscape, and we should make data available earlier for investors in that context. Unfortunately, as of now, it is not the case. So what you will have access to is potentially using CDP data for the indicators we already had. You could, basically use that, the last data point available for some of those principal adverse impacts. But for this specific year and disclosure cycle, unfortunately, the deadline for companies to answer, I think, is between July and end of August. And so usually we tend to share that data afterwards. But it's something that is very much top of mind and is very important consideration for making sure that we can help you as much as possible, basically.
Okay, and I don't know, just Michelle has a follow-up question, and then I think we'll close it off. She asks if previous year's information is a good proxy for this year.
That's also a good question. I think if I would give my opinion, there's so little data on this that, yes, I would say, any information is a good proxy. And at the end of the story, CDP data fits through the ecosystem of other data provider. But I remember myself when I worked with a series of data sets for carbon emissions, it's not always clear that you have the latest data point. It's not always clear that your data on certain companies is not from 2019, 2021, and so on. So I think rule of thumb is to have methodologies for you to assess the quality of your data. So having the awareness of where the data comes from and what year it refers to is very important. But everyone recognizes that as long as there's not any European single access point, like public data available at all times, we're going to have to work with the best data we can. So yeah, my intuition is that you can think about approximating a company's exposure by using past information, at least for some of them.
Okay, and on that note, I think we can let people have 5 more minutes of the day. I don't know if you want to close it off, Helen.
Yeah, sounds good. Thank you very much for listening to the presentation. And I will see if there's any follow-up questions. I will, try to answer offline, and also please, reach out on any of those topics. We're here to support you on this. Thank you very much. Bye.